The content of this video, as well as the thoughts, views, and opinions expressed herein, belong to the presenter and do not necessarily reflect the views of Brigham Young University or the Church of Jesus Christ of Latter-day Saints.
Hello everyone, and welcome back as we continue on with our presentation on financial considerations for a senior mission. I'm excited to be here with you again today. My name is Alec Johnson, and I'm a certified financial planner at Peterson Wealth Advisors. Previously, we have discussed the costs of serving a senior mission, what health insurance looks like, how you can maximize Social Security, and how to invest during your mission. Today, I'm going to be talking about potential tax strategies that you can implement with your service. Now, quick disclaimer here, the information provided in this presentation does not and is not intended to constitute tax or legal advice. Instead, all information, content, and materials available are for general informational purposes only. So in other words, I will be speaking at a very high level today about what tax strategies you may investigate as you prepare to serve a mission. But I do not know your current financial tax situation. Please consult with your tax advisor before implementing any of these strategies to ensure they make sense for your own unique situation. Now, the overall question that I hope to answer for you today is, what tax strategies can I look to implement while I am serving? I am often asked by my clients, how much of my retirement income is taxable? And what will my tax rate be after I retire? And for this presentation, we could add in, how will my taxes look while I'm serving? These are excellent questions, and with proper planning, you can absolutely end up having a better tax outcome. I have had multiple clients who were unaware of the tax savings that could be created by simply serving their 1 or 2 year mission. I truly feel that these strategies are very underutilized, so we want to be sure to get out the word out to you and those looking to serve, as these strategies can sometimes create multiple thousands of dollars of tax savings. However, as a word of caution, these tax saving strategies can sometimes be mishandled. Like your investments, it is vitally important for you to follow a plan while you're serving on how you will best utilize these tax strategies. Before we dive into the 4 tax planning strategies that I want to discuss with you today, such as donor advised funds and Roth conversions, I think it's important that we first discuss the taxation of different account types, as well as how we are taxed in the first place. Knowing the taxation of different account types helps us to manage our tax brackets effectively. So let's start there. Broadly speaking, you have 3 account types, each with its own unique tax advantages. The first is tax-deferred accounts, such as 401ks, 403bs, and traditional IRAs. Generally, contributions to tax-deferred accounts will reduce your taxable income in the year that you make the contribution. Contributing to your 401k does that very thing, reduces taxes because that income is not reported or taxed. Once you make the contributions, then those savings grow tax-deferred, meaning that you will not pay taxes on any gains, interest, or dividends that you earn over the course of your working career. Once money is distributed from these accounts, however, they are 100% subject to ordinary income tax. Now, unfortunately, you can't leave your savings in these accounts forever. The IRS requires you to take required minimum distributions, or RMDs, from your tax-deferred accounts each year, starting at either age 73 or 75, excluding your 401k if you're still working. The second account is these tax-free accounts. So unlike tax-deferred accounts, contributions to Roth 401ks and Roth IRAs are made with after-tax dollars, so they won't reduce your current taxable income. As contributions go into these accounts, they also grow tax-free. When you withdraw money from these accounts, you won't owe any taxes on the income, which includes any appreciation or growth over the years. One unique note to remember is that Roth IRAs and Roth 401ks are not subject to those required minimum distributions. Lastly are taxable accounts, otherwise known as brokerage accounts. Whether you have a bank account that is a high-yield savings account or an account where you purchase CDs, the taxation is the same as a brokerage account. These accounts are funded with after-tax dollars, and the flexibility these accounts provide is that you can sell investments and contribute or withdraw money at any time for any reason without penalty. Any taxable investment income is taxed in the year it's earned, and investments sold for a profit are subject to capital gains taxes. Now, each of these three account types can play a significant role when it comes to tax planning, so it's important to identify which account types you have. Now that we've covered those different account types, I also want to make sure you understand some basics as far as how we are taxed and that you understand how our tax liability is actually calculated. If any of you are CPAs or accountants, please do not hold against me how simple I'm going to try to make this. This is a very high-level view of the individual income tax formula. You start by adding up all of your income to get to your gross income. Once here, you are allowed to subtract certain deductions called above-the-line deductions, and doing this gives you your adjusted gross income, or AGI. Once you have your AGI, you get even more deductions called below-the-line deductions. To determine what you will deduct, you add together all of your itemized deductions and compare that with the standard deduction. You will subtract the greater of the two to get your taxable income. Your taxable income is the number that you will actually pay taxes on. So once here, you will apply your income tax rate. Currently, those rates range from 10 to 37% federally to calculate your tax liability. We're almost there. Next, you subtract any tax credits you are entitled to, like the child tax credit, for example, which finally brings you to either your taxes due or your refund. What I want to focus on for just a minute is what I have highlighted here on the screen in red, where you subtract those below-the-line deductions. When it comes to below-the-line deductions, you get to take the greater of your itemized deductions or the standard deduction. The IRS has a list of things that we can count towards our itemized deductions, including mortgage interest, state and local taxes, property taxes, medical expenses that exceed 7.5% of that adjusted gross income, and a big one is your charitable donations. If you add up all of these deductions and they are not higher than the standard deduction, then you're simply going to take that standard deduction. If the total of those expenses is higher, then you'll end up itemizing. In 2017, the tax laws changed as part of the Tax Cuts and Jobs Act. Part of what changed was that the standard deduction was doubled. You can see here on the screen that in 2024, the standard deduction for a single filer is $14,600, and for a married couple is $29,200. So again, for a married couple, if their itemized deductions don't add up to more than $29,200, they'll take this standard deduction. What this essentially means is that with the larger standard deductions, most of us will forego itemizing our deductions, and we will end up taking that standard deduction. Previous to the law change in 2018, about 30% of Americans itemized. It's now estimated that about 10 to 13% of Americans itemize their deductions. So, how does all of this impact those that give to charity? Well, although gifts to qualified charities are still available as an itemized deduction, most donors will not receive any tax benefit from their donations because few will donate enough to charity to exceed that standard deduction. Therefore, there's really no tax benefits for donating to charity for the 87 to 90% of Americans that don't itemize. The good news is there are still actions that we can take to reduce your taxes, especially when you are serving your mission. That leads us into our first strategy, which is bunching and donor advised funds. Bunching is the strategy that is used to maximize your deductions. You are already familiar with the concept of bunching because you already bunch other things in your life. For example, we bunch medical expenses. Let's say you have a $5,000 deductible on your health insurance policy, and you know that you're going to have a knee replacement surgery next year. Because you know that next year your deductible will be satisfied, you'll wait until next year to have any other medical procedures done. Another example is that of credit card reward points. Many of us earned reward points on our credit cards that we can redeem for airline tickets. We don't typically redeem these points when we make shorter, less expensive flights because we're willing to bite the bullet and pay for the normal airfare for those less expensive tickets. We save or bunch these points and use them when we can benefit the most. For example, we redeem our points when we take a Hawaiian vacation and will be incurring larger costs. Just as we can reduce our medical costs and travel costs through planning and the bunching of our benefits, we can likewise bunch our taxes. For tax deduction bunching to work, we want to bunch all of our itemized deductions into a single tax year. So bunching means that you're going to pile on all of your itemized deductions every other year and elect to take the standard deduction in the alternate years when you have fewer deductions. In the year that you plan to itemize, it is vitally important to pay every tax-deductible bill, incur every tax-deductible expense, and then the big thing here is you want to donate 2 or 3 years' worth of donations to your favorite charity, all in the same tax year. All of which will result in those higher itemized deductions. Since you are here looking to serve a mission, I'm going to take a wild guess and assume that your favorite charity is the church. So you could donate your tithing, fast offerings, and even prepay for your mission as part of your tax-deductible charitable donations. As far as your missionary expenses are concerned, I am referring to the housing portion of your mission, which for a couple looking to serve maxes out at $1,400 a month, and for a single sister at $1,200 a month. I will talk more about this throughout and at the end of the presentation. Practically, how this may work is during the year that you itemize, you pay your regular tithing and other donations as often as you want, such as monthly, throughout the year. And come December, you prepay through a lump sum all of your next year's donations. I just want to give you a quick glimpse of how this works. Let's take it, for example, Brother and Sister Miller. Now, I'm going to grab my laser pointer to help you out real quick. The Millers have $24,000 of deductions each year, of which about $10,000 go towards charity. Now, in option 1 here, if the Millers decide to pay their $10,000 of tithes and offerings in separate years as demonstrated, they won't be able to itemize either year, as their total deductions only amount to $24,000. Therefore, they will take the higher standard deduction in both 2023 and 2024 and receive a total 2-year deduction of $56,900. In option 2 on the right, we can see the tax-smart approach. The Millers decide to pay their tithes and offerings regularly each month throughout the year of 2023, and then at the end of 2023, they prepay all of 2024's tithes and offerings in one lump sum payment. Thus, they can claim a $20,000 deduction for the 2023 tax year, which then combined with the $14,000 of other deductions, they can now itemize. Then, in 2024, they will again take the standard deduction as it is higher than their itemized deductions would be in 2024. So, this approach creates a total deduction of $63,200 over the 2 years, which is an additional $6,300 of tax deductions simply by changing the timing of their charitable donations. Now, a common question we get is this: is there a way to bunch my deductions and still pay my tithing or mission expenses as well as other charitable contributions on a more frequent basis? The answer to this question is yes. That's where a donor advised fund comes in. Now, the donor advised fund is not an investment, but rather a tool. Donor advised funds, or DAFs for short, have been around for years, and there are a lot of them. They have become increasingly popular over the past decade, and you can open them at big financial service companies like Fidelity, Vanguard, and Charles Schwab. So what are they and how do they work? The best way to describe a DAF is that it is an account to hold your charitable contributions until you decide when and to what charity you would like to ultimately donate to. So how this works is you, the donor, will make a charitable donation to a donor advised fund. This donation can be in cash, or better yet, in the form of appreciated shares of stock, which we'll talk more about in just a minute. The donor then receives their tax deduction for the contribution in the year the contribution was made. Your donation will then sit inside an investment account within the DAF until you direct your contribution to be sent to a qualified charity, including the church. Essentially, the timing of the donation from the DAF is up to you as the donor to decide. Here are some practical applications of these donor-advised funds. Number one, with a DAF, bunching your deductions becomes easier to do, and charitable giving can be more flexible and easier to accomplish. Number two, a DAF helps the donor to get a tax deduction when it is advantageous to the donor. One thing I want to point out here is that we often have clients selling businesses when they retire or that have larger, higher earning income years before they retire. Donating to a donor-advised fund during those big income years can help you get a big deduction when you need it, and then you can essentially prepay for certain charitable endeavors, such as serving a senior mission. Again, I am referring to the housing portion of your mission that can be paid for using that donor-advised fund. Third, a donor-advised fund can create a legacy for future generations. For example, think a missionary account for your grandchildren. Strategy number two is donating appreciated assets to charity. Now, many taxpayers fail to recognize the tax savings that can be realized by donating appreciated assets to charity. Appreciated assets or investments that have gone up in value are excellent items to donate and can result in huge tax savings. This is gifting appreciated assets that are in taxable accounts and that are not part of your 401ks or IRA accounts. So referring back to that slide I showed it towards the beginning, think of the third bucket on that slide, the very right one. Donations in kinds are gifts of non-cash assets. Now, there was a time back in the good old days that most charitable donations were made in kind. Instead of using cash to pay tithing and other church obligations, the members of the church would bring what they produced to the bishop's storehouse. Tithing was paid using eggs, milk, bales of hay, or other agricultural products. The church, as well as other charities, still accept certain donations in kind. Our ancestors would pay their tithes and offerings by donating apples. And today, we too can pay tithes and offerings by donating apple. It's just a different kind of apple, apple stock. I hope you're laughing at that. I really like that joke, but when I told my wife, she did not find it as funny. It is a very common practice to donate appreciated stock to charity, which can result in generous tax savings. All charities, including the church, know how to receive donations in kind. Charities accept almost all marketable securities, such as stock, mutual funds, and exchange-traded funds. Some charities will even accept gifts of real estate, life insurance policies, and even partnership interests of privately held corporations. It is worthwhile to check with the church to see all of the assets that can be accepted, but this is a great strategy. Let me give you a quick practical example here. Let's take the Andersons. Over the years, the Andersons have saved for retirement and now have a portfolio of individual stocks. One of the stocks that they own is Apple. They bought $10,000 worth of Apple stock 10 years ago, and today those same shares are worth more than $120,000. As you can see in the left column, if the Andersons were to sell $25,000 of Apple stock and then donate the cash to the church, they would end up paying $5,000 in federal and state taxes, and the church would end up getting $20,000. As you can see in the right column, if the Andersons donate $25,000 in stock, they won't pay any tax whatsoever. So here's the benefits of the Andersons donating their appreciated stock in kind. First, the church gets an additional $5,000 or a 20% greater donation. The Andersons don't pay any tax on the gain of the stock. The Andersons get to deduct $25,000 versus $20,000 as a charitable contribution. And the Andersons can now use the cash that they otherwise would have paid to the church to buy a more diversified portfolio of stocks and start that process again. So before you write your next check to the church or another charity, you may want to ask yourself, do I have any appreciated assets that I can donate to my charity that will be more beneficial for me than writing this check? Now, this strategy obviously saves you from paying the capital gains tax and is great on its own. But when coupled with bunching or donating to a donor-advised fund, then we start piling on those tax savings. You can donate appreciated stock to help pay for your mission. Strategy number 3 is qualified charitable distributions. Using qualified charitable distributions, or QCDs for short, is the most effective tax strategy that I know to save you tax dollars through gifting. Unfortunately, QCDs only work for those age 70 and a half or older. But since we all know we'll be age 70 and a half before we know it, if you aren't already there now, I thought it would be beneficial to share with you. This information is also important to know prior to 70 and a half for planning purposes. A QCD is a provision of the tax code that allows a withdrawal from an IRA to be tax-free as long as the withdrawal is paid directly to a qualified charity like the church. There are huge tax savings that can be realized by incorporating the use of QCDs. But it's important to note, these tax savings are brought on not by how much is paid to the charity, but by simply altering the way the contributions are made to the charity. Now, a few advantages of QCDs. One, you didn't have to pay any income tax when you earned the money and put that into your IRA or 401k. Two, you didn't pay taxes on the compound interest within your IRAs over the 30 or 40-year working career that you had. And third, any money paid directly to a charity using a QCD from your IRA will not be taxed. That is triple tax savings. Now, doing a QCD can benefit you in many ways. One, you can pay the housing portion of your mission through a QCD. Again, $1,400 for a couple, $1,200 for a senior sister. Number two, it will potentially reduce the amount of Social Security that will be taxed. Third, it will reduce the overall amount of income that is taxable. Fourth, it will enable you to get a tax benefit by making a charitable contribution regardless of if you itemize your deductions or not. This is a huge point. And fifth, qualified charitable distributions count towards satisfying those required minimum distributions that the IRS has for us. Again, age 73 or 75, depending on when you're born, the IRS is going to force you to pull out money from your 401ks or IRAs that they've been so patiently waiting to tax. These tax-free donations through a QCD satisfy those RMDs. Now, as beneficial as QCDs are, they unfortunately are not available to all taxpayers, and the rules governing these distributions must be followed with exactness, or the QCD will be considered a taxable IRA distribution. So here are the rules. Again, they are only available to people older than age 70 and a half. They are available only when distributions are coming from IRA accounts. Withdrawals from 401ks or other types of retirement accounts like 403bs are not QCD eligible. You would have to first roll it over into an IRA. A QCD must be a direct transfer from an IRA to a tax-qualified charity. There is a maximum of $100,000 of IRA money that is allowed to be transferred via QCD to a charity each year. And then the IRS has special reporting requirements for QCDs. You should check with your CPA or your accountant to ensure they report your donations correctly. Now, I believe that every person over age 70 and a half who has an IRA and who gives to charity should investigate making charitable contributions through these QCDs. You and your accountant can run tax comparisons by paying charitable contributions with cash versus these tax-free transfers from your IRA, and you'll likely see significant tax savings. Now, this brings us to the last strategy, which is considering the benefits of a Roth conversion while serving your mission. I want to point out really quick that this strategy may or may not be for everyone. A lot of people hear that Roth is better, that Roth is king, but this isn't always the case. So please exercise caution on this strategy. So what is a Roth conversion? As I mentioned earlier, virtually all retirement accounts are classified in one of two categories. That is, they contain pre-tax money or post-tax money. For most retirees, it is much more common to have retirement accounts that are pre-tax money. What a Roth conversion allows you to do is take a pre-tax retirement account and convert it, either all of it or a portion of it, to a post-tax Roth account. Keep in mind that just as the name suggests, any money in a pre-tax account has never been taxed before. That being said, any amount that you choose to convert becomes taxable to you in the year the conversion is performed. For this reason, it is very uncommon to convert an entire account at once, as it would likely push you into a higher tax bracket. and make your tax bill unnecessarily large. If you think about it, if you convert $1 million all at once, you can expect to pay close to 40% in taxes. Generally, the advice we give to clients is to convert enough to get the future benefit of a Roth conversion, but not too much that it pushes you up into that higher tax bracket. Now, a common misconception is that it is better to pay taxes now and let them grow tax-free than vice versa. The truth is that it doesn't matter whether you pay taxes now or later if your tax rate is the same. So often deciding which one is more advantageous in your specific situation comes down to the amount of time that you have to invest, as well as what tax bracket you are in and when. Now, knowing that the conversion is all taxable, it begs the question, well, why should I do a Roth conversion? How do I know if it's beneficial for me? Well, there are several situations and benefits where a Roth conversion would help you in the long run. First, when your current income is low, so you're in a lower tax bracket, and expect to be in a higher tax bracket in the future. This is an opportune time to do a Roth conversion, as you will pay minimal taxes up front in the lower bracket rather than the higher bracket. Senior missions provide an excellent opportunity to take advantage of Roth conversions, and I'll show you an example in just a minute. Second, most oftentimes, we will use Roth accounts as the last place where we take retirement income from. Again, there are RMDs that have to be satisfied in those pre-tax accounts, so oftentimes we'll pull our income from there first. This often leaves the Roth IRA to be left to simply grow in the background. Not only that, but because we're not utilizing it for short-term expenses, we can invest it more aggressively, thus accelerating the tax-free growth. This can provide a benefit to you as later in retirement you have a source of tax-free income, or a benefit to your heirs, as any inheritance left in the Roth will be tax-free to them as well. Lastly, another advantage of doing a Roth conversion is that Roth accounts do not have those required minimum distributions. For a lot of folks, between other sources of income like Social Security, their pensions, they often do not need any distributions from their pre-tax accounts for their living expenses. What often ends up happening is an RMD will now push you up into a higher tax bracket when you didn't even need the money. If your account would have been converted to a Roth, you would not be required to ever take any of it out, and so any amount can continue to grow for you. Now let me show you a quick example of why a mission can be a great opportunity to take advantage of the situation. Let's take brother and sister Parker. Before the Parkers leave on their mission, and when they return home, their income needs are at $10,000 a month. At $10,000 a month, the Parkers find themselves squarely in the 22% federal tax bracket, which means if they were to convert $15,000 before or after their mission, they would create a $3,300 tax bill. When they go on their mission, they will only need $6,000 a month, as their discretionary spending is going to go down while they serve. At $6,000 a month, they are in the 12% tax bracket. Now, a $15,000 Roth conversion means that a tax bill of only $1,800 was created. That is a $1,500 savings, or 10%, that their serving their mission created. Now, just a quick reminder, if you're in the same tax bracket before and during your mission, it really doesn't matter, and those Roth conversions lose their appeal. Okay, that wraps up the last strategy I wanted to share with you today. As a final review, here are those 4 strategies again. Bunching and donor-advised funds, donating appreciated assets to charity, utilizing qualified charitable distributions, and considering Roth conversions while you serve. I strongly encourage you to meet with your tax advisor and see if any of these strategies could be beneficial in your situation as you prepare to serve. Now, I want to end with just some final tips and tricks for your mission. First, your monthly housing expense can be tax deductible. Again, we're talking about the $1,400 a month for a couple, $1,200 a month for a single sister. However, if you are renting your home while serving, that deduction varies. For example, if a couple rents their home for $500 a month while they serve, they can only deduct $900 a month when they file their taxes, essentially the difference, $900 being the difference between that $1,400. If they rented their house for $1,800 a month, they could not deduct their housing expense. Second, your vehicle costs and other items may be tax deductible. We always advise you to consult your tax advisor before you leave to see what may or may not be deductible. And third, don't pay too far in advance for your mission. We generally recommend paying for your mission around a month or a quarter at a time in case you come home early. When it comes to your charitable donations to the church, you can recategorize your donations, but it's very difficult to get them refunded. That concludes the tax strategies portion of our series on financial considerations for a senior mission. Once again, I hope this presentation has been informative so that you can serve your mission with all your heart, might, mind, and strength. In our next presentation, Alex will talk about estate planning considerations surrounding your mission.